Good morning, everyone. We're back. This is our last briefing for the week. So, welcome to Friday. And it has been relatively calm, I think, all things considered, in the US markets in particular. Today, we're going to jump into Apple soft launching their Vision Pro headset, the crazy goggle headset. If any of you have seen it on social media, internet news, they're launching the product $3,500 to a, I guess, select group, appointment only type user. And then, they're looking forward to launching a second iteration of the headset as they sort of work some of the kinks out. And so, Apple soft launch, we're talking about the job market, and as always, interest rates and how they're connected. And then the heat is on for tech and finance. That'll be kind of wrapped into that same job market conversation. So, bear with me. We'll try to keep this interesting and sweet and short. But for now, let's start with Apple. So the Vision Pro headset is this sort of future reality, next gen version of the internet. I mean, or as the consumable iteration of the internet for that next phase. It's almost like now from our personal handheld devices, we expect a similar trajectory that we did for gaming devices. How every so often they would bring out a new piece of hardware to upgrade graphics, to upgrade screen and visual components, new UI, new UX, new games. That was pretty much kind of the routine that we got into in the gaming world. Of course, you're all familiar. We've gotten in the routine of buying the latest and greatest iPhone. Apple has delivered very consistently for the last decade plus, 20 years realistically, on this, keeping consumers extraordinarily happy. A couple of things that I've always paid attention to regarding Apple has been that they're rarely the first mover when it comes to one breakthrough element of a piece of hardware or software. It's extremely rare that they release a truly unique feature in a device. What they always look to do is to build the overall best holistic experience in their products, and it's been something that I've been both critical of and now I look at and I just admire, because they really are intense about pleasing the customer and business building in a realistic way. They're not trying to be NASA and have the sort of sexiest test pilot plane out there for the extreme enthusiast. They're really going after the main bulge bracket consumer. And in the case of the Vision Pro headset, they are really taking that ethos and hanging it out there for everyone to see. And it's really impressive to see such a large company with so much capital, with so much cash, with so much intellectual property and talent internally take such a kind of startup approach to launching a breakthrough product. So it's at a high price point, right? So not everyone's going to go buy it. Only the extreme enthusiasts are going to buy it. I'm wearing these crazy glasses. Actually, I forgot to joke and open with this, but in honor of the Vision Pro headset, because these are only a fraction of the size of how they will look on people's faces when they buy them. But $3,500 price tag. At the end of the day, it's going to come home at almost $4,000 if you're paying New York tax, that type of thing. The apps and the interface and the OS are all going to be glitchy and underperforming and maybe underwhelming, because that's typically how they roll out these new kind of bleeding edge products at Apple. So high ticket, probably going to be buggy. There's already complaints of people feeling them on their face, it's uncomfortable, etc. So that first gen is almost like a beta test that's being financed by the consumer. So very fascinating to see Apple just continue to hammer on that ethos of like, we will do things incrementally so that we can have the very, very best offering for the mass consumer. So exciting news about the launch. I'll probably stop by the store and check them out at some point. I know that they're going to hurt my head and my face, and I have headaches and very sensitive to light and that sort of thing. I'll take these off because they're kind of ridiculous. So next, we'll jump into the job market and rates. So I was looking at the ADP report, and that's the private sector report that comes out on a monthly basis to try to lead the official public record of, how many jobs the economy is adding, losing, how salaries are growing. And the ADP report is notorious for being a little bit volatile and a little bit off the mark. And I saw it roll through a couple of days ago, and it was showing, an expected job growth of 230 something thousand, or no, expected payrolls, 230 something thousand, and came in at 600,000. So a complete blowout of the expectations, which is good. I mean, it means the job market is still strong, it's still growing. But then the actual employment numbers came in, and it was the most added jobs in June were in education and health services. It trailed the actual estimates, but it's an example where it's telling us that, like, hey, the job market is still relatively strong. We have different sectors that are taking the tops of the league tables, but there's a little bit of volatility across the perceptions, and I think that's why we're seeing, some of the reports coming in overly strong, public reports coming in a little bit weaker. So we're starting to see a little bit of tug of war in the job markets, and I think that this is coinciding with some of the broader concerns in the economy, a little bit of what we saw in rates. For example, the Federal Reserve decided to pause raising interest rates last month, sending a little bit of a mixed message to markets. I mean, if you're just kind of like a equities trader or something like that, you take that message as, okay, this is good. This means inflation's cooling. The Fed is relaxing. Let's go 2 hands into U.S. stocks, maybe U.S. technology if you're really aggressive. And the reality of that is the Fed's like, we're pausing, but we're raising again. They're not seeing inflation cool down where they want it to. The job market remains really strong. So they're not really generating the shakeup that they're looking for with raising rates, which typically when a central bank raises rates to fight inflation, it's supposed to dampen economic activity a little bit, slow down the job market, slow down the consumer, get everyone to kind of relax and pause so that the supply side can kind of catch up and prices can sort of reset at a lower rate. If everything is gangbusters, if job market gangbusters, wage growth gangbusters, consumer demand really strong, very hard to lower inflation, especially with just interest rates. What'll end up happening is at a certain point, the rates will have to go so absurdly high that it's going to break stuff. And we kind of saw that at the beginning of the year with some of the regional banks and anyone who was kind of out there engaging in tomfoolery with, either bad loans, mismanaging a bank, or trying to take advantage of some condition that no longer existed because rates went up pretty abruptly. And so the heat is on for tech and finance. This morning, I just kind of wrote that sentence. I was inspired by just all the blasting across these two industries. One, of course, that rates conversation. Two, we're hearing about continued rounds of job cuts at some of the mega growth, mega tech companies. This morning and yesterday, Mark Zuckerberg and Meta were getting blasted for their new Threads app, which is somewhat of a Twitter competitor, but supposedly just has a lot more controls and kind of the social media sphere is complaining about lack of privacy and concerns like that, that it's a worse data steward than Twitter, but we'll continue to explore that. I saw that a Lazard high Lazard executive was ousted for some nasty behavior. We have, of course, the commercial real estate concerns and bubbles, and that's not going to get any better. Not bubbles, but just general concern that the market will be aggressively repriced. That won't get better as interest rates go up. You'll eventually have large real estate holders who it's like, hey, I can't afford my monthly expenses at these rates anymore. I need to sell this property at whatever price I can sell it at. And it's kind of, a game of musical chairs. And who's the sort of first to make big sales. And I've been seeing also that funds, Blackstone, for example, they've been in the news for the past year plus about, kind of some negativity surrounding their real estate funds. And that's had to do a lot with liquidity, their ability to give investors who are investing kind of blindly in Blackstone's ability to acquire high quality and high yield real estate and package it for them. in exchange for their cash. And part of the reason that investors put money into these funds is because the fund managers say, you can give me $1 million this today, I'll let you take out all of your money next year, and then comes the time to take out the money and the fund says, hey, we can't give you back your money because either we need to sell something that we can't, we don't have the cash reserves on the side to give you your money, or something's broken or something bad is happening. So the CRE situation, the commercial real estate situation, certainly heats up, especially if rates go up. So a lot of financial firms are behind the real estate, so it's certainly hot water for these businesses. Technology just catching some flack, like I mentioned on Meta and Zuck, regarding the new app. But in general, the industry is trying to find its size. When we go to the sort of mega caps, we've heard of cuts, we've heard of pauses, but we'll continue to see that, especially as rates go up. It's going to deepen the pain for some of the technology companies who have done remarkably well this year. So there is, a part of me that's a little bit nervous for that shoe to drop if this pain continues. The good news is, in the whole picture here, is that the indication that we're getting from the Federal Reserve, the indication we're getting from a lot of analysts is like, maybe it's higher for longer, maybe interest rates will stay higher for longer. That puts more pressure, more gravity on things like tech, on things like on things like loans in particular. Should create a better environment for banking, but we continue to see issues there. It shouldn't be so painful. That was sort of the latest I took away from Powell's comments and from the Fed's comments, is that, if we enter a slight recession at the end of the year, it shouldn't be terribly devastating, and it should kind of course correct as everyone tries to bring down prices and while keeping the economy growing and whatnot. So that's all I have for today, guys. We will catch up on Monday. Stay tuned in the Discord. We'll be posting stuff and sharing news. We'll be getting a little more active there. We're bringing in some backup to assist with that stuff. So anyways, we'll catch up. Take care. Feel free to ping us or the team or book a meeting through the Discord if you're on there. Take care.